In 2022, the Bank of Canada raised interest rates by 4%, and it hit variable rate mortgage holders really hard. Some saw their payments jump by $1,400 or more. Meanwhile, folks who locked into a fixed rate mortgage back in 2021 or early 2022, well, they're sitting pretty. It's easy to see why a lot of people think fixed rate mortgages are a safe choice, but here's the real question. Is that true in 2025? Is a 5-year fixed rate still the way to go, or could sticking with a variable rate actually make more sense? In this video, I'm going to walk you through 5 big reasons why a 5-year fixed mortgage might not be the right move now. We'll talk about interest rate trends, penalties, flexibility, and how to really think about your risk tolerance when making the right choice. Oh, and here's something important. Some economists are currently putting chances of a recession at over 90%. And historically, that means rates could come back down. And if that happens and you're locked into a fixed rate mortgage, you might regret it. But before we dive in, I'm Justin Chausse of the Chausse Mortgage Group. And if you're looking to make smart, informed decisions about your money, especially when it comes to your mortgage, make sure you subscribe and hit the like button so that you keep getting videos like this. All right, so let's get into it. Now, just to clarify, I'm specifically talking about 5-year fixed rate mortgages in this video. There may be valid reasons to consider shorter term fixed products like 1 or 2 year terms, but that's a different discussion. Whether those are smart options depend on how interest rates behave over the next year or so. I've also created a video why you should pick variable rate mortgages in 2025 and another that directly compares fixed and variable rate mortgages. I'll link both at the end of this video so that you can get the full picture. Key takeaway, this isn't about timing the market, it's about understanding your own risk profile and making the best decisions for your situation. So how do you decide between a fixed and variable rate mortgage? It starts with one thing: risk tolerance. That's the number one factor. Not market predictions, not your neighbor's opinion, not what rates did last year. Trying to time the market or outguess interest rate trends is extremely difficult, even for the experts. So don't make your mortgage decision based on where you think rates are headed next quarter. Instead, ask yourself, am I the kind of person who needs stability, or can I handle a little risk in exchange for flexibility and potential savings? Let's break down 5 specific reasons why fixed rate mortgages might not be right in 2025. Reason number 1, you think rate might drop. If you believe interest rates are going to fall in the next 12 to 24 months, locking into a 5-year fix could leave you stuck paying more than necessary. Now again, you shouldn't try to specifically time the rate market, but if you're generally confident that rates have peaked and we're headed into a rate cutting cycle, then it may not make sense to lock into a long-term rate that could significantly be higher than what the market goes. Variable rates can allow the benefit from any rate reduction coming as the economy slows down. Number 2, you're comfortable with some risks. Let's say you have a higher risk tolerance and you're okay with some fluctuations in your monthly payment. In that case, you may be a better fit for a variable rate mortgage. Historically, variable rates outperform fixed in most interest rate cycles, especially over the long term. If you can ride out a bit of short-term volatility, the long-term math could very well work out in your favor. Fixed rates offer predictability. But if predictability isn't your number one priority, and if your budget can absorb some changes, you might not need the extra cash of certainty. A quick word on mortgage traps. Before we continue, if you're house shopping or renewing your mortgage right now, you need to know that the world of mortgages is full of fine print, hidden clauses, and unexpected traps. This stuff catches people off guard all the time. One of the biggest mistakes we see, borrowers locking into options that seem safe, but in the end costing them thousands of dollars down the road. Like variable rate mortgages with fixed payments that don't reduce your principal when interest rates rise. So always make sure that you have somebody in your corner that's able to help you understand the fine print and make sure that you're protected. Reason number 3, you want to avoid big penalty. This one's a biggie. One of the most overlooked risks of a fixed rate mortgage, the penalty if you break it early. Most variable rate mortgages come with a straightforward 3-month interest penalty, but fixed rate penalties, especially with the big banks, can be massive. Some are literally 3 to 5 times what you would pay with a mortgage-only lender like MCAP or First National. If you think there's any chance you'll refinance, sell, or move before the end of your term's up, a fixed rate could cost you tens of thousands of dollars. And here's the thing, most Canadians break their mortgage before the 5-year mark. It's not rare, it's actually normal. Reason number 4, you might move. If there's even a small chance that you might move in the next 5 years, new job, bigger family, different province, you may want to avoid avoid a fixed rate mortgage. Yes, lenders say fixed rate mortgages are portable, but there's a catch. You have to keep the same amortization and use the same lender. That's often not realistic when you're upsizing or relocating. We've seen so many cases where people sell their home and are thinking about porting their mortgage only to find out that they don't qualify for the new place or their lender can't accommodate them. Now they're paying a huge penalty on top of arranging a brand new mortgage. Don't let your mortgage become a pair of handcuffs when life changes. Reason number 5, you might need to refinance. Let's talk about flexibility. If there's any chance that you might need to access the equity or remove a cosigner, renovate or consolidate debt, a 5-year fixed could really limit those options. Fixed rate mortgages are more expensive to break, and if you need to refinance before the end of the term, that penalty can make the entire plan unaffordable. Even in cases where it's not impossible, a big payout penalty can make the numbers just not work, especially when you're trying to pull equity to manage higher living costs, inflation, or financial curveballs. So here's the common thread. Fixed rate mortgages reduce flexibility. They lock you into a specific structure with harsh penalties that can really hurt when life changes. Let's face it, life almost always changes. In our view, the financial risk of big penalties often outweigh the higher risk of interest rates. You may or may not agree, but at least you now have a clear picture of the trade-off. As always, do your due diligence, speak to a mortgage professional who actually explains this stuff, not just one who tries to sell you the safe option without any context. If you want to explore both sides of the conversation, make sure you check out our video on why you shouldn't choose a variable rate mortgage in 2025, and the follow-up where we directly compare fixed and variable rate mortgages in 2025. See you in the next one.